Look at your screen. That cascading red candle you're seeing right now is not a glitch, and it is not a standard market correction. In the last 48 hours, $10 billion in liquidations have systematically evaporated from the crypto ecosystem. If you are feeling a sense of vertigo, you should. We are witnessing the single largest deleveraging event of the post-ETF era. But here is the cold, hard truth that the mainstream media is missing. This was not a retail panic. This was not mom and pop selling their fractional Bitcoin in a fit of fear. What we are analyzing today is a surgical, coordinated institutional exit. The whales didn't just leave the building, they set it on fire on their way out, to ensure they were the first ones through the exit row. Today, we are going deep into the mechanics of this collapse to understand if the floor is actually in, or if we are just falling through a false ceiling. This deep dive is built on 3 unbreakable pillars of evidence. First, we are opening the hood on the blockchain. I will show you the exact on-chain movements from dormant whale wallets that moved billions into exchange hot wallets minutes before the dump. We are tracing the smart money's footprints in the digital snow. Second, we are going inside the halls of power. Rumors of an SEC emergency meeting are no longer just rumors. We have identified the regulatory triggers and the specific stablecoin red lines that have sent shockwaves through institutional trading desks in New York and Singapore. Finally, we look at the macro graveyard. With the Federal Reserve maintaining a higher for longer stance and global liquidity drying up, we must ask the ultimate question. Is this a healthy flush of overleveraged moonboys? Or are we officially entering the gates of a multi-year crypto winter? The data does not lie and the clock is ticking. Strap in. $10 billion is gone. Let's find out where it went and who is holding the bag. To understand how $10 billion vanishes in a heartbeat, we have to look past the surface level price action and dive into the plumbing of the global crypto exchanges. What we witnessed was not a simple sell-off. It was a sophisticated liquidation hunt executed with mathematical precision. First, let us talk about the difference between spot dumping and the over-the-counter market. Usually, when a whale, an entity holding thousands of Bitcoin, wants to exit a position, they use an over-the-counter desk. This allows them to sell massive amounts of supply without alerting the public or crashing the price immediately. But in this 48-hour window, the whales did the exact opposite. They bypassed the privacy of the OTC desks and moved their assets onto the spot books. This was a deliberate signal. By hitting the spot market, they created slippage, a scenario where there are not enough buy orders to absorb the sell pressure. Why would a whale want to crash the price of their own asset? The answer lies in the derivatives market. For every $1 of spot Bitcoin, there are often $20, $50, or even $100 of leveraged bets riding on its price movements. These are called perpetual futures contracts. As the spot price began to slide due to the whale's initial dump, it hit a tripwire of automated sell orders. Imagine a ladder of glass. Each rung represents a price point where thousands of retail traders have placed long bets using high leverage. When the price hits 38,000, the exchange's risk engine automatically liquidates everyone who bet the price would stay above 39,000. To liquidate those positions, the exchange is forced to sell that Bitcoin back into the market instantly. This creates more downward pressure. This hits the next rung at 37,000, triggering even more forced liquidations. This is the derivatives death spiral. In this specific crash, we saw a record-breaking long squeeze. Within 1 hour, over $4 billion in long positions were forcibly closed. Now, look at the funding rates. Before this crash, funding rates were ultra-positive, meaning the market was dangerously long-biased. When the dump started, these rates flipped violently negative. Suddenly, long traders were being charged massive fees just to keep trades open. The $10 billion figure represents the total open interest wiped off the map. The leverage fuel has been completely drained, but the carnage did not stop with Bitcoin. We have to discuss the beta correlation and the cross-margin contagion. When Bitcoin positions failed, exchange algorithms began seizing and selling other assets like Ethereum and Solana to cover the debt. In a healthy market, market makers ensure there is always someone to trade with. However, during black swan events, these firms often go dark. When market makers vanished, the order books became thin. A sell order that would normally move the price by $10 was now moving it by $200. This brings us to the most chilling part, the exchange inflow mean. Yesterday, that mean spiked to a 3-year high. While it's dormant since the 2021 bull market suddenly woke up and dumped. This is institutional distribution at its most aggressive. The $10 billion liquidation was the cleansing of the temple, but the question remains, who was waiting at the bottom? That money did not just disappear, it was transferred from the hands of the overleveraged many into the pockets of the calculating few. Now that we have diagnosed the $10 billion hemorrhage, we have to ask a terrifying question. Why was there no one there to catch? The falling knife? In a normal healthy market, a 5% or 10% drop attracts dip buyers who provide a floor. But yesterday, the floor didn't just crack, it vanished. This is what professional traders call a liquidity vacuum. It is the most dangerous environment an investor can face. To understand the vacuum, you first have to understand the role of HFTs. High-frequency trading firms, or HFTs, are the market makers of the modern era. They operate sophisticated algorithms. These bots provide both buy and sell orders at all times, making a tiny profit on the spread between them. On a typical Tuesday, these bots provide the deep order book depth that allows you to buy or sell Bitcoin with minimal price impact. But these algorithms are programmed with strict risk volatility parameters. When the whale dump hit, the speed of the price drop exceeded thresholds. What happened next was a flash freeze. The HFT algorithms didn't just slow down, they went dark. They pulled their buy orders from the books entirely to avoid being run over by the cascading liquidations. Imagine a busy highway where every car suddenly vanishes, leaving a wide open road. That sounds good until you realize the danger. In a market, those cars are the only things stopping you from driving off a cliff. With the market makers gone, the spread blew out. This meant a small sell order was suddenly able to teleport the price down by 3 or 4% in a single second. This leads us to the algorithmic feedback loop. Many traders use stop-loss orders to protect their capital. When the liquidity vacuum occurred, these stop-loss orders were triggered, but there were no buy orders on the book. Market sell orders executed at much lower prices than intended. This is known as negative slippage. This forced selling fed the monster, creating more downward momentum without any organic buying to slow it down. We must also analyze the cross-protocol contagion within DeFi. Bitcoin is the sun that the entire crypto solar system orbits. When the Bitcoin liquidity vacuum hit, it triggered oracle failures in lending protocols like Aave and Compound. Oracles are the data feeds that tell a smart contract the price. During a flash crash, these oracles often lag or provide stale pricing. When the price teleported down, protocols saw collateral was worth less than loans. This triggered atomic liquidations. Automated code sells off Ethereum, Solana, and Chainlink to preserve protocol health. The DeFi beta correlation went to 1. Everything crashed together because the liquidity vacuum in Bitcoin sucked the air out of every other room in the house. This was an algorithmic failure on a global scale. It proved that despite billions in TVL, the market is still incredibly fragile. The crypto market is fragile when the smart money market makers decide to pull the plug. This vacuum is the smoking gun of a coordinated exit. If this were natural retail panic, you would see a messy chart. Instead, we saw a straight line drop. This suggests the entities selling knew exactly when the market maker algorithms would retreat. They didn't just want to sell Bitcoin, they wanted to break the market spirit. As the dust settles on this $10 billion crater, we have to look at the regulators who were watching from the sidelines. While the charts were bleeding red, a different kind of fire was starting in Washington, District of Columbia. As the $10 billion liquidation cascade hit its peak, reports surfaced of an unscheduled closed-door emergency meeting at the SEC. To the casual observer, this might look like a standard regulatory response to market volatility. But for those of us who track institutional flow, the timing was far too precise to be a coincidence. We have to look at the systemic risk mandate that drives these emergency sessions. The SEC's primary public mission is investor protection, but their private obsession is contagion control. When Bitcoin drops 10% in an hour, regulators aren't worried about the retail trader who lost $500. They are terrified of the interconnectedness between the crypto ecosystem and the traditional banking sector. We are now in the era of the Bitcoin spot ETF, which means the wall between crypto and Wall Street has been torn down. Major brokerage firms, pension funds, and insurance companies now have direct exposure to these price swings. The core agenda of this emergency meeting centered on stablecoin collateralization and a massive depegging risk. If a major stablecoin loses its $1 peg, it creates a run on the bank scenario. This is the nightmare scenario for the Fed. A crypto crash triggering a liquidity crisis in the treasury market. During this meeting, the discussion reportedly turned toward the legal framework of exchange oversight. The SEC has been looking for a reason to tighten the noose around offshore exchanges that provide high leverage. By framing this crash as a market manipulation event, the SEC gains the political capital for aggressive new rules. They are effectively using this crash as Exhibit A to argue that crypto is still a Wild West. But we have to address the institutional insider theory. Did the whales know the SEC meeting was coming? In the world of high finance, information asymmetry is the greatest weapon. If an institutional desk received a soft warning, their fiduciary duty would be to exit the position immediately. This explains why the dump was so coordinated and why it occurred just hours before the meeting. Furthermore, the SEC is under pressure to ensure crypto isn't used as a liquidity escape hatch for sanctioned entities. A controlled deleveraging of the market flushes out non-compliant capital into the regulated silos of Wall Street. The SEC is not trying to save your portfolio. They are trying to contain the asset. Every time the government meets in secret during a crash, The rules of the game are being rewritten for the house. The crypto winter we face might not be caused by lack of interest, but by a surplus of regulation. We have analyzed the $10 billion crime scene and the regulatory fallout. But now we must face the most haunting question of all. Is the 4-year cycle officially dead? For a decade, investors have relied on a predictable rhythm, a halving event followed by a supply shock, leading to a parabolic move to the moon. But as of today, the cycle theory is facing a total degradation. We are no longer trading in a vacuum where Bitcoin is the only game in town. We are trading in a macro graveyard, where the ghost of inflation and the reality of high interest rates have changed the rules of engagement. To understand if we are in a crypto winter, we have to look at the 200-week moving average. Historically, this has been the iron floor for Bitcoin. When we broke through that floor yesterday during the liquidation event, we entered uncharted territory. This wasn't just a wick below the line. It was a sustained 4-hour close below historical support. This suggests that the institutional floor we all believed was built by the spot ETFs might actually be made of thin ice. If the Federal Reserve continues its higher for longer interest rate policy, the opportunity cost of holding a volatile asset like Bitcoin becomes too high. For the pension funds and insurance giants, they are moving back to the safety of 5% Treasury yields, leaving a liquidity desert. Next, we must address the minor capitulation phase. This is the most brutal part of any true crypto winter. Bitcoin mining is a business with massive fixed costs, electricity, hardware, and debt service. When the price drops, the profit margin evaporates. We are currently seeing a massive drop in the network hash rate, which indicates that miners are turning off their machines. To survive, these mining firms are forced to dump their treasury reserves, thousands of Bitcoin they have held for years, just to pay their power bills. This creates a secondary wave of sell pressure that retail traders simply cannot absorb. But what does a modern crypto winter actually look like? It is no longer about Bitcoin going to zero. Instead, it is a massive consolidation and culling of the herd. We are seeing a capital flight to quality. During the last summer, money flowed into every meme coin, layer 2 solution, and non-fungible token project without a second thought. In this new winter, that speculative capital is dead. Only the protocols with genuine revenue and real-world utility will survive the frost. We are seeing a great decoupling, where Bitcoin may stabilize while thousands of altcoins bleed out to a 99% loss. This is the institutional cleanse. The goal of this phase is to shake out the weak hands and the over-leveraged gamblers, to make room for the regulated future. If you look at the logarithmic growth curve, Bitcoin is still in a long-term uptrend, but the slope of the curve is flattening. We are transitioning from the wild growth phase into the mature asset phase. This means the days of 100 times returns may be over, replaced by the volatility of a standard commodity market. So, has the winter returned? For the average retail investor looking for a quick, get-rich-quick scheme, the answer is a resounding yes. The easy money has been burned in the $10 billion fire. But for the value investor, this is a market reset. The winter is when the infrastructure for the next decade is built. While moon boys cry, smart money is quietly accumulating. The frost is here, but it is in the cold that the strongest steel is forged. The $10 billion liquidation we witnessed today is a historic scar on the chart. But in the world of high-stakes finance, every scar tells a story of a new beginning. We have peeled back the layers of the institutional dump, the liquidity vacuum, and the systemic shifts at the regulatory level. The message is clear. The era of blind speculation is over, replaced by a cold, calculated institutional framework. Your strategy moving forward must evolve. Do not be the retail trader who provides the exit liquidity for a whale. Focus on self-custody, prioritize protocols with actual revenue, and respect the macro environment of higher interest rates. The crypto winter is not a death sentence. It is a filter that separates the noise from the signal. If you found this deep dive valuable, hit the like button and subscribe to stay ahead of the next liquidation wave. Turn on your notifications, because in this market, being 5 minutes late means being $10,000 short. I am your host, and this is the front line of the digital frontier. Stay sharp.